Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to a very important session of accounting for passive investments, wherein we are going to talk about the three different categories and the different aspects of accounting that we going to learn. This is part of the 26th reading of your financial reporting analysis module, which is of CFA level 1. Now, I'm sure that the viewers, before looking at this session, would have already looked at two other videos wherein we had first talked about the overview of the passive investments, and the other wherein we had talked about the fair value model. Now, under the overviews reading, we had talked about that there are two ways of accounting for a passive investments. One, the fair value model, wherein every time the valuation on the balance sheet date happens at the fair value and the change goes to the P&L account. And we had also done a lot of practical examples in it. The second way of accounting for a passive investment is according to three different intentions of holding. Now, this is where we are going to focus upon in this particular recording. Now, in place of fair value model, the slide says the investor can account and report for the investment as per his intention of holding. So the key word here has also been highlighted for your convenience, is intention of holding. There can be broadly three intentions of holding. One, where the objective of the investor is not to sell a particular security till it actually matures. So by this we mean that the horizon is very long term. So to speak, let's say if it's a 20-year-old bond, then the objective of the investor is that he's going to hold this particular bond till the 20th year. Now, obviously, you are aware that a private limited company is based on the going concern assumption, wherein we assume that every company, whether private or public, is going to go on till eternity. Therefore, the equity share of a particular company may never be able to be classified under held till maturity, because we are will be self-contradicting ourselves if we will classify equity share, which is infinite life, and on the other hand we are saying that we will hold it till maturity. Now, therefore, equity share doesn't have a maturity itself. So the short point here is that equity shares cannot be classified into HTM. However, for the sake of comparison and on an apple to apple basis, to make a one-on-one to draw a parallel between all three, I will assume equity share to be classified under HTM, but that's again going to be just for the sake of convenience and explanation. Technically, your equity shares cannot be classified in HTM, and only the debt securities can be classified here. The second category is, I would like to explain held for trading first. Your held for trading is very short term, is almost like an intraday, where the objective was to sell it right there and then. The third category is a hybrid or the cusp area, wherein we are broadly talking about 12 to 18 month of investment horizon. What we are trying to say is that this is available for sale, but we are not in great hurry. So in a manner, it's actually between the two, and therefore has got characteristics of both the neighbors, and therefore is the most important from exam point of view as well. So let's just look at different rules of all the three. We're saying that the first point here, that what is the value at which the balance sheet will be prepared. So for held till maturity, we are saying it's only the historical cost without worrying about the daily fluctuation. We are going to completely ignore any kind of unrealized loss. So as you see that the slide here talks about that you're not going to recognize itself, you're going to completely ignore any unrealized gain or loss. In case of available for sale and held for trading, the valuation is always done on a market price basis, which is mark to market, the fair value of the security prevailing on the day of valuation. Now the question here is, if we are marking it to market, we are actually recognizing the unrealized gain or loss. The key point here is that although the gain and loss are recognized by both the second and third category, the treatment is a little different. The held for trading, which was very short term, takes it directly to the income statement and impacts the financial performance. However, your second category, the available for sale, actually recognize it as an income or expense, but not impacting the financial performance. Therefore, they take it to OCI. There are some similarities also in all the three category, which is that any kind of realized income, be it the regular income like dividend or interest, or upon the sale of this security, is going to go to the income statement. That means there is no discussion of OCI the moment we are talking about anything realized. Now, before going on to the practical example, I'm sure that the viewers are aware that your realized gain or loss is equal to cash sale price minus cash purchase price. This is what we had explained in one of our previous videos, and the unrealized gain or loss is equal to the market value on the balance sheet date as reduced by the cash purchases. So that's basically some of the basic formulas that we have been talking about. Let's look at the practical example. The figures of some of these examples have been kept constant from the previous reading in order to make some parallels and for better comparison. Now here we are again assuming that PQR had purchased one share of Apple for $45 and it was held. That means it wasn't sold. That means it is unrealized gain or loss. Now in my case it is a loss of $5. Now the question is, what is the impact on different financials in 2014, which is the next year, if the share was sold for $39? Now you would be aware that there are 2 years of accounting, 2013 and 14, and in the question we need to consider all the three cases one by one. So what I'm going to do is I'm going to draw a table sort of thing for the sake of convenience of everyone, and in that table I'm going to take all the cases one by one. So let's say these are the different types, wherein first I am taking held till maturity. The question is, what is the balance sheet value, what is the P&L of the first year, and the OCI, and I'm going to explain A is equal to L plus C also parallelly. That's really the magical equation which every viewer must be very confident about using in the exam. Now coming to the figures, now since it's a held till maturity, my market valuation will be at the historical price. That means on 31st of December there wasn't any change in the value of the asset, therefore no gain recognized, therefore nothing comes into P&L nor the OCI. An important point to be noted here is that there is no conservatism at play. It's the treatment of ignoring the unrealized portion is not only for the gain but also for the loss. Now let's extend this example and say what will happen in the next year when this security will be sold. And for the next year again I am going to draw A is equal to L plus C for the sake of convenience. Now here what we need to understand is this is 2014 and this all is 2013. Now on 5th of January, since you have sold the security for 39, your cash is going to come for 39 and your investments are going to go down by 45. Don't look at the net change right now. I want you to focus upon the capital here. Now the rule for realized gain, let's first calculate how much is the realized gain. Your realized gain is cash sale, which is 39 minus 45 equal to minus 6. Now the short point is the realized gain needs to go to the P&L of the cumulative ownership period, which means the first year and the second year put together in the P&L should be equal to minus 6. I had put 0 in the last year, so entire minus 6 is going to come this year. So there's like an important rule that I just told you, that realized gain will always go to P&L of ownership period cumulatively. So what it says is P&L, I'm going to just write cumulative ownership period. This is very, very interesting to understand and explain. Let's talk about the OCI. Now since it's an HTM security, OCI will not come into picture. Net P&L changes by, it actually reduces by 6. So overall the equation gets tallied, and that's how your HTM security is valued. Let's talk about what will happen in case of the trading security, which is the most liquid portion. For trading security, we had said that the valuation will always be at the market value, which means we are reducing the value on 31st of December by 5, which means we are recognizing the unrealized loss. In case of trading, the unrealized goes to the income statement right away, and there is no question of OCI. Let's see what will happen next year, wherein we will sell this security. So your cash is going to come for 39. Your investments are going to go down by the previously recorded value of 40. That's the change on the asset side. Out of the total realized loss of 6, we have already booked 5. So the balance 1 is going to be booked in this year by 1, and OCI anyways doesn't come into the picture. Now should we see whether the equation has tallied? The asset side is down by net 1, and the capital side also. So that's about the accounting for a trading security. Pretty simple and interesting as well. The third, and actually the most important, is the accounting for available for sale. I'm going to just extend these lines. In case of available for sale, what you need to understand is that it's a hybrid model. It's a cusp area, so it will have characteristics of both trading and held till maturity. In case of available for sale, as we have talked about, that the valuation always happens at the market value, which is $40. There is an unrealized loss of $5, which is recognized but is not transferred to P&L and is temporarily parked in the OCI. So that's how the equation gets tallied. The valuation is at 40 and OCI gets down by 5. In case of the next year, your cash comes in worth rupees 39, your asset has been valued at 40, so that's the change on the asset side. The realized gain remains minus 6, out of which you haven't transferred anything in the previous year, so entire 6 gets transferred this year. Now that's a little bit of catch here, that your asset side is down by 1, but so far your capital is down by 6. That means there is some other adjustment which is required to be done, which in this case is your OCI, which was temporarily parked till last year. Now, since the transaction has been realized, you are going to just reverse whatever was the impact. Just don't understand that we are doing it because of conservatism. Whatever is the impact on OCI will be reversed this time, and your net change on capital will also be equal to -1. So I hope that the first example was useful and interesting for the viewers. We have more examples, so please stay tuned to more videos. Should you have any feedback or comment on the reading so far, we'd be very happy to help you. Should you mail us at finstudyclub@gmail.com. This was Ankur Kulshrestha. I look forward to speak to you in my forthcoming recordings. Thank you.